And welcome back here on another video on how to secure yourself financially. Particularly, well, how to secure myself and hopefully you as well financially. So here again, looking at the Morning Star, this North American financial service that offer education and investment research to their investors. So looking at the featured content, now that I know staying investment in the market and the key concept of that, the TLDR is that stock has provided the highest return and increase in the wealth. Holding on can pay off in the long run. Investors must have discipline and patience. On average, the accumulated return perceived by small stock after the end of a recession outperform those of the large stock after 1 month, 6 months, a year, and 3 years after the end of a recession. And lastly is what are the interest rates and how the Fed are set the or how the Fed targets the federal fund rates by buying and selling government securities in the federal open market. And you may wonder, like, okay, so perhaps uh, concept like stocks, bonds, federal interest rates is something that I'm not quite familiar with. If you're new looking at this video, so I'm going to make a quick recap of the reason why, after mentioning is the things to know, all right? Because Morningstar show you is this historical data over the last 94 years examination of past capital market return. When we talk about capital, is the form of wealth in cash or property that allows you to earn income. That's one definition. The other is the net worth of a company in which their assets are greater than its liabilities, or is something that you own free and clear. And when you have this mindset, or this way of looking things, okay, uh, what's going on here? Okay, here, no, I don't know. What about you? Okay, no, nothing. Okay, cool. Again, future content. Oh my god. But if I open in a new tab here, are you able to open this? Okay. But why you don't open that here? In any case, okay. Um, some UI issues, user interface issues. In any case. So the importance of looking at or by having this mindset about capital, or what is the definition of capital, that is something that you own free and clear, for example, your time. That's one of the reasons why I'm dedicating time to look at these topics, especially because I come from a country where they're they're just a mess handling and managing their own resource. To me, it's like I just want to understand what are the underlying, the foundations of all of the things that we are in, right? And with that, well, not only to absorb that, but also be able to articulate, to mention, to talk about that, and to create this dialogue, this conversation with other people. Perhaps right now is with me, later on it will be with others. But in any case, so yeah, so this is what is capital when on the financial aspect, the term returns refers to the earning on security or any other investment, such as dividends, realization of profits, income, like uh, receipt as well. And by looking at this historical data, okay, see how the stock performed way much better an hypothetical $1 bet on 1926, and after that it crashed out, and after the market crash or the Great Depression, and also how over these 94 years, 90, 97 years, uh, what is this? Okay. Perhaps this is something abstract here, but is this right? How about after 94 year examination of this past capital market returns, well, indicate you that an hypothetical one bet dollar on the stock markets, on small stock, large stock, government bonds, and treasury bill and inflation, so stock has provided a highest return and increasingly well back then, right? Again, this is not guaranteed to repeat itself, okay? But it can show you the market potential while also looking at the period of consecutive negative return and understand that investor must have discipline and patience because on this market downturn, that the major market downturn uh, that has happened are from the Great Depression and during during the Second World War, during the Yom Kippur War, and the dot-com bubble in the early 2000s, and also the banking and crisis, the banking and debt crisis from 2008, and lastly, the coronavirus. So, okay, so with this, okay, so with this, uh, I also look and I also mention is uh, that holding on can pay off in the long run, especially when looking at crisis and long-term performance, right? Also, how the stock performance after recession, especially small stock, they outperform on average uh, the accumulated return perceived by small stock outperform those of the large stock after 1 month, 6 months, a year, and 3 years after a recession, or after the end of a recession, right? And then the history interest rate, which is something, this is a very interesting topic. Why? Because you don't know, here is telling you first what is interest rate, okay, which is a rate that a rate that is charged, uh, a rate where you can. So interest rates is a well, interesting. Okay. Interesting. Very interesting. It's like their website has some issue here. It's like their website has some issue here. Okay, doesn't matter. Oh, No problem. I think they did this on purpose. Yeah, I think they did this on purpose. Yeah, I think they did this on purpose. Because now they don't show you this, right? Now they don't show you this. Use. Okay. I don't know what's going on with you. And it's not blocking any pop-up. And for some reason, I'm not able to even open that. Okay. And for some reason, I'm not able to even look at that. Or are their definition. Mhm. Okay. Okay. Um, Interesting. Very, very, very interesting. But in any case, just to make this quick over recap, because they now are not presenting is the concept here, they're just showing us a label. Okay, perhaps under the hood they modified their front end to not show that data. Okay, exactly, and yeah, to not show that data. Yeah, yeah, they don't want to compromise themselves. I'm assuming this. So in any case, when they talk about the history of interest rate, okay, that the interest rates is the charge, or is the interest rate is the amount in which money is the amount in which borrow money will cost or saving you will earn. Uh, and when I look at this, is well also the loanable fund market. That this loanable fund market is the same as the this is an example of that. So the loanable fund markets can be thought as similar as when you are in a family, your father and mother, most likely, and then you ask loans to them, and in their benevolence, so they give you is 5% interest rates when you ask them for money, right? This is one way so you can put that from a more closer example or perspective, or something that it can be that where we all have fairly in common, right? You like it or not, perhaps your family is more dysfunctional than others, but most of the time you have them, most of the time. But so by looking here at the history of interest rate, right? That this is the loanable fund market, okay? And the loanable fund market is where buyers and sellers, particularly is lenders and borrowers, make transactions. When you scale that, like corporations and governments, they usually do that through a financial institution. And this interest rate, or in the loanable fund markets, there are a number of interest rates reflecting loans per risk and time length. So, a shorter example of interest rates are the federal fund rate, a treasury bill, or 1 year government maturity bond. So, why I'm explaining this? Because when I look at this, the things to know is that the U.S. Federal Reserve, where this was created by the U.S. Federal Reserve Act in 1913. So imagine how it was the Federal Reserve, or how the economy regulate itself uh, in the during the 18th century. So there is something called the bank wars. Bank wars. Okay. The bank works. Wikipedia. Bank works exactly. Bank work. There is this. It was a political struggle that developed over the issue of rechartering the second bar of this rechartering the second bank of United States during the presidency of Andrew Jackson. What we're talking about is this: in 1829, 1837, the affair resulting in the shutdown of the bank and its replacement by state banks. So there is a reason why the U.S. Federal Reserve exists. Again, I am not justifying all of their actions before, and just wants to know and mention that there is a reason why they exist. You know, deal with that. So the U.S. Federal Reserve, okay, that was founded in 1913 by the U.S. Federal Reserve Act of the same year. So the Federal Reserve, that it has a couple mechanisms to regulate monetary policy, such as the discount rate, something that I'm going to explain later, the discount rate, prime rate. It also regulates the economy by printing money, lending money, uh, oversee is the banking system, and also buying and selling government securities, or security here. Okay? The U.S. Federal Reserve set the target federal fund rate, the rate at which commercial banks lend funds each other overnight, and tries to achieve that target by buying and selling security in the federal open markets. And when we talk about security, okay, security are a financial instrument. It's a so security are a fungible financial instrument that hold some monetary value. So a type of security can be is uh, stocks, and they usually are equity. So that's security for that. Uh, that the owner, uh, or that person, the owner, owns that certain part of the company. So that security are usually are called stocks, and where the owner is a debt holder, uh, they usually are from bonds. So understanding here the security concept, security here, security, so finance, okay, from investor B, investopedia, okay, well, security, well, investment security, security lending definition, with a debt security, collateral types, an example, uh, exactly, security. So what are financial security? A fungible, negotiable financial instrument that holds some type of monetary value. Is this? It's funny how they draw this as a key and then like a candy, or lens. Okay. But what is a security? The term security refers to a fungible, negotiable financial instrument that holds some type of monetary value. Okay. A security can represent ownership in a corporation in the form of stock. Exactly. The term security refers to a fungible, negotiable financial instrument that holds a monetary value. And a security can represent ownership in a corporation in the form of stock or a creditor relationship with a government body or a corporation represented by owning that entity bond. All right. So uh, this is an important concept, especially for those people that are working for a particular job, 9 to 5 job, wherever. Understand all of these concepts, the foundation of the game, the monopoly. Okay, but understand that in don't hit the player, don't hit the game, love the game, understand the game, the reason why this exists. Okay, uh, but yeah, so that's a security. Okay, now going back here to explaining about this, just yeah. So the U.S. Federal Reserve set the target federal fund rate and try to achieve that target by buying and selling security in the federal open market. The issue is that when the uh, market crash, so much like in the stock market, the bond market is also affected by the state of the economy. The interest rates on bonds are affected by the demand of loanable funds. So during a contraction, the demand for loans fall, making the effect. So yeah, the demand for loans fall, causing the interest rate to rise. Causing the interest rates to drop, and during an economic expansion, the demand for loanable funds increase as their interest rate. So to understand this more about it, Morningstar has a course, particularly a section called the downturns, the market contraction and expansion, and the downturns and recovery. Okay, so again, looking at this historical data, for some reason you're not able to show me that, and I don't get it, man. It's like you they modify their website. I know they did. I know they did. I know they did. Yeah, yeah, they modify their website, and I know they did. I know they did. But in any case, so we're looking at the market in terms and recoveries by first. That the importance of looking at this is for investors help how the market performs and understand for those who wants to have a long-term horizon, such as retirement, how the market performs and that how risk decrease over time. Okay, and how risk decrease over time. So things to know is that by looking at this 10 market contraction that happens over the last 49 years, that set an end of the that set an end of a market cycle, meaning a complete round of a stock price fluctuation. So the contraction phase is defined when the market stock value falls from its peak 10% or more. And this is something that may vary in time length. It's happening at random time as well, random times, because the owner of those systems know when that will happen, or they're more likely to know when that happens. And during an expansion, which measure is the performance of an index, or it measure is the recovery. The recovery is the boom in price security following a long decline. The term is also to describe the activity nations or the upswing nations activity economy. And during this or the recovery measure is or the expansion, correct. So the expansion measure is the recovery of an index. This is a statistical reference that uh, this is a statistical reference of investment expressed as a percentage in a period of time. That the whole idea of this index is to measure progress. So during the expansion, that it measures the recovery of an index from the very bottom of the contraction from its previous peak and the subsequent performance until the next level peak before another 10% decline. The whole idea of this, looking at this data, is investor should have a long-term horizon to allow their investments to grow. And when I look at the market downturns and recovery, which this is one of the things that struck me the most, because right now I'm living this recession. Okay, so market downturns and recovery is, well, a historical account. So we're looking at this historical account of the past market downturns and recovery to see and to get a better picture of the potential markets that the most severe market US equity downturn. And here, what is the term equity? So equity is the total asset minus its liability, the net worth of a company, the amount of shares you own from a company, or the value of a property minus its liens. And liens are legal right to someone else possess your assets or property, particularly. It's a legal right to someone else possess your property uh, until a debt is repaid or an obligation is met. Okay, or an obligation is met. So the U.S. equity market that has passed through several downturns. The most severe all of that it was at the start of the Great Depression, when the recovery took over 12 years. Uh, yeah, the recovery period took over 12 years. 12 years. And more recently, we have is back then the market lost 80.3%, 83.4% of the value over 80%, but it lost specifically, according to Morningstar, 83.4% over the stock the stock value, and more recently, the stock lost 44.7% uh, during the early 2000 bear market. Okay. So during the early 2000 bear market, the stock lost 44.7% at the dot-com bubble. In this recovery period lasting 4 years, and in the 2007-2008, or the banking and debt crisis, when the stock lost over 50%, so 50.9% specifically, the the recovery took over 37 months. That's almost three. That's 3 years. That's over 3 years. That's over 3 years. My God. That's one of the reasons why I'm dedicating time to learn all of this, to understand that, and then what will be the decision that I got to do from this and so on. What will be the course of action in my life? How am I going to architect my life, knowing this? Okay, cool. Uh, mhm. In this sudden pause that I took, it was to analyze here. Is like pondering, thinking about that. It's like it was, man. And so what are you gonna do? So what are you gonna do? That's the question. So what are you gonna do? So okay. But the things to know here is that, well, stocks are prone to sudden loss in value for many different reasons. So then I look at, so after I saw is the market downturns and recovery, especially the contraction and expansion phase. That even though that investors who have a long-term horizon, uh, yeah, so for investor, are you gonna open that? No, right. So for investors who have a long-term investment horizon, let to allow them to investment to grow over time. Yeah, because this is something that took me not only quite to understand, it's because something that I'm facing right now. Not only this, that the is from the market contraction and expansion, that investor should have a long-term investment horizons to allow their investments to grow. Okay, and also during the market downturns and recoveries. What? Okay, what's going on, man? During the market downturns and recovery, okay, is that stocks are prone to sudden loss in value for different reasons. So once I look at this, right, specifically market contraction and expansion and the downturns and recovery, how long those recovery uh, take, okay, or the past, or how long all of those, yeah, for how long all of those recovery period took, okay, and now, well, analyze this market downturns and recovery, but with different asset classes, such as bond, stocks, some other asset classes, and some sample portfolio structures. We'll also look at the correlation of different assets with the broader market. So first I saw is the bond yield through recession. It's like okay, so bond yield during recession, they are driven by several factors: the supply and demand for loans, monetary policy, and inflation. So the Fed has two mechanisms to regulate monetary policy. One of the driven factors that are affected that affect bond yields, and that is discount rate and the discount rate and the how do you call that? So yeah, the discount rate and the federal fund rates. So the discount rate, which is either the interest rate that the Federal Reserve charge band for short-term loans, or the interest rate that is used to discount future cash flow from discount cash analysis, and this discount discount cash or discount cash flow, exactly. So in the discount cash flow is a valuation method for estimated time, okay, is a valuation method for estimated time the value of an investment, okay. So DCF is a valuation is this. So DCF is a valuation method to estimate the value of investment based on a future expected cash flow. Or it is expected future cash flow. Okay. So DCF analysis attempts to figuring out the value attempts. It's not a guarantee. Okay. So DFA attempts to figuring out the value of an investment today based on projection on how much money it will generate in the future. Okay. So why am I looking at this? The discount cash flow, and also talk about is the cash flow, which is the movement of money in and out of a company. The net amount of cash, or the net amount of cash in cash equivalent being transferred in and out of the company. So the reason of looking at this is not only to understand this concept, but also to apply that in real life. You know what it means? And I'm looking here at the cash flow because uh, when I saw is these two mechanisms that the Fed has to regulate monetary policy: the discount rate, either the interest rates that the Fed charge to bank for short-term loans, or the rate used to discount future cash flow from the discount cash analysis. And the discount cash flow is a evaluation method, but it's a valuation method to uh, estimate the value of a company, or is to estimate is the value of an investment based on its future based on its expected future cash flow. Cash flow, the movement of money in and out of a company. The net worth, the net amount of cash and cash equivalent, asset that they can dispose easily for that. The net amount of cash or cash equivalents being transferred in and out of the company. And this is something important because you, now that you see these broader tools that the Fed actually use to regulate the monetary policy, so you can make use of that knowledge and apply that to your particular business, whatever business you want to create, right? And also, I look at the cash received means inflow, cash spent means outflow. Okay, and also something important is that a company cash flow is typically categorized as a cash flow from operations, investment, and financing. Where did this come from? That's the question. Where does this come from? So, this comes from the Beginner Guide of Financial Statement, something that I read 2 days ago. And if you can read a nutritional label, and I really like this introduction. So if you can read a nutritional label, if you can read a nutrition label, or a baseball box score, or a soccer box score, you can learn to read basic financial statement. If you can follow a recipe or apply for a loan, you can learn apply for a loan. Interesting. I never applied for a loan, not at all. So if you can follow a recipe or applying for a loan, you can learn basics accounting. The basics aren't difficult, and they aren't rocket science. Yeah, they're not. Yeah, they're not rocket science. They aren't rocket science. Yeah, so this brochure is designed to help you gain basic understanding of how to read financial statement, just as a CPR classes teach you how to perform the basic cardiopulmonary resuscitation, something that I never. Uh, uh, honestly, honestly, I don't know how to do that. I saw that way with so back this like a long, long time ago. So just as a CPR class teach you how to perform the basic of cardiac pulmonary resurrection, this brochure this section will explain you how to read the basic part of a financial statement. how to read the basic part of a financial statement. It will not train you to be an accountant, just as a CPR course will not make you a cardiac doctor, but it should give you the confidence to be able to look at a set of financial statements and make sense of them. Let's begin by looking at what financial statements do. Okay, show me the money. So we all remember Cuba Gooding Jr. immortal line from the movie Jerry Maguire. Immortal, yeah, whatever. From the North American people, from the US people. Show me the money. Well, that's what financial statements do. They show you the money, they show you where a company money came from, where it went, and where it's now. Understanding this financial statement. So financial statements are like that. You know? Financial statement. Um, yeah, let me take a moment here by looking at this. Okay. Mm, what time is it? That's right. Okay. 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 Yes, just 4 minutes more to look at this, to understand is the basic here. The beginner guide to financial statement. Okay, so let's begin by looking at what financial statement do. Is show you the money. So financial statement show you the money. They show you where a company. They show you where a company money came from, where it went, and what is now. Okay, where company money came from, where it went, and where it's now. There are four main financial statements. Okay, so first looking at the description and then the categories. So yeah, so the definition of financial statements, they show you the money, where the company money came from, exactly. So where company money came from, where it went, and where is it now. And it's funny because it's like people wants to people want to trace back money that comes from this is something funny because governments and corporations wants to figuring out is how do you get that money and if that money are not from any illegal activities. Okay, and the funny thing of this illegal activity is that who do you think you receive that money? There must be an audience, a public, clients that are giving you that for some reason, for any reason. For example, and I'm not justifying this, Pablo Escobar. So how he earned all of that amount of money? Because people in Miami, they just wanted to live that particular lifestyle during the 70s and the 80s. It's like that. So they promote that lifestyle. And it is funny because they just want us to keep their own people the U.S. government wants to keep their own people following a particular narrative, meaning, meaning, keep believing that the drugs are the bad. The drugs are bad instead of teaching them, okay. But the issue with that is that if you teach something, you may lose control. So that's one of the reasons why most government act as this parental advice. They have this parenting property in there because of course they don't want to control. They don't want to lose control. And I get it. Totally. But there is a cost on that. In any case, that's another topic. That's another debate. And here, I just want us to understand is what is a financial statement, which shows you the money, where a company money came from, where it went, and where is it now. And there are four main financial statements. So you have his balance sheets, income statement, cash flow statement. That's the reason why I'm looking at this, and statement of shareholder equity. Okay. So with that, I'll wrap it up this video. So give you a nice day. Wish you a nice day, and I'll see you later. Take care. Bye bye.